In today's video, we'll see how to build a winning ETF portfolio that beats the market with just $1,000. We'll see exactly which ETFs to invest in, how much you need of each ETF based on your risk tolerance and goal, and the return you would have had if you had built this portfolio 10 years ago. In the end of this video, I'm going to give you access to a new tool that I created for you and that you can download completely for free, that is going to create a portfolio suggestion for you based on basic questions like how old you are, how much money you want to invest, your investing experience, and so on. And the tool is going to suggest which ETFs you need to buy, it's going to tell you exactly how much you need of each one of them, and it's also going to calculate which return you would have had if you invested in this portfolio 10 years ago. My name is Rick. If you're new to this channel, you're welcome to subscribe to it because I'm sure you're going to find a lot of interesting content in it and a lot of free tools for your investing journey. And now let's go right to the first point of our video, which is what I call the trick. The trick is nothing more than the answer to how can I get a return which is better than the market and better than the average investor. And the answer to this is that your ETF investment portfolio must be based on three important key factors. Number one, growth potential. If you want an ETF portfolio that returns more than the market, inside the portfolio you need to include ETFs of innovative sectors or outperforming indexes. Otherwise, and I do it very often in my channel, I could just tell you to buy an ETF like VTI, the Vanguard Total Stock Market ETF, and with this, your performance will be exactly the one of the total stock market. But today, we're going to try to beat that. Number two, diversification. It's true that growth sectors have been performing better than any other in the past 10 years, but without diversification, you're going to carry a risk which is way too high. Imagine how growth investors felt in the year 2000 when a dot-com bubble burst took down the whole stock market and the growth sector lost over 80% of its value within a couple of months. And you don't want to find yourself in a situation of losing 80% of your wealth. Otherwise, I would suggest you to go all in on cryptocurrencies. Number three, low expense ratio, namely low management fees that you pay on the ETFs of your portfolio. I receive many comments about ETFs with 0.4, 0.5, sometimes up to 1% fee per year. But if you want to grow real wealth with your portfolio, you need to keep expenses low, and that's what we're gonna do. Now let's go straight to my newest tool, which I call the ETF Portfolio Builder. Cool name, huh? Grab it for free from the link in the description below. And be nice and spend 1 second of your time to like this video and subscribe to the channel, because if this channel grows, I'm gonna be able to invest more time into creating such tools for you that are gonna help you in your investing journey. So be nice and support me with a like. So how does this tool work? The only cells that you need to insert something in are the yellow ones here. The first question is your age. This is important because starting at 45 years of age, I start suggesting including bonds in your portfolio. So for example, if I write here 45, the tool suggests 35% in BND, which is the Vanguard Total Bond Market Index Fund ETF that represents the bond market. If I write 60, it's going to suggest me 50% in bonds. So you understand where this is going. The percentage of bonds, according to my suggestion, is going to be your age minus 10, but only starting at 45 years old. If I write here 44 or less, the tool doesn't suggest you buy any bonds, as you can see here. The rest of the portfolio in the current configuration is all in VOO, the Vanguard S&P 500 ETF. This ETF includes the 500 best and largest companies in the American stock market and is always my suggestion number one that should be included in all portfolios as a foundational ETF. VOO returned 33% in the last 12 months, 106% in the last 5 years, and 246% in the last 10. As an alternative to VOO, you can go for SPY, IVV that are equivalent, or VTI that instead of the best 500 companies includes all companies of the US stock market. One thing that I'm often asked is, should I include bonds in my portfolio or not? To put it in simple terms, the closer you are to retirement, the more you're going to need bonds. Bonds will always perform worse than stocks in the long term. And the only way for bonds to perform better would be if we get to a market in which interest rates are as high as 12-13%. But the last time the US market had such high interest rates was at the beginning of the 80s. And honestly, I don't see a reason why they should become so high anytime soon. Still, bonds are important for a portfolio in retirement because they are less volatile. Namely, their prices don't fluctuate as much as the ones of stocks or equity ETFs. Here in this table, you see which return your portfolio would have had every year from 1997 to 2022, depending on how much of it is bonds and how much of it is equities. So 80-20 means that you have 80% in the total stock market and 20% in bonds. All the way to 2080, that means that you have 80% in bonds and 20% in the total stock market. The same is also represented in this table. The blue line is 80% equities and 20% bonds. And you can see here that the line fluctuates more, going from minus 30% to plus 40%. The green line instead is 2080, the opposite. And you see how it fluctuates less and is almost never under zero. So the fact that it rarely gives negative performance is the reason why in retirement you're going to have a safer portfolio if you have bonds. Because in retirement, it's not about growing your portfolio, it's about preserving it. But you're going to pay in terms of long-term performance. Now, getting back to our ETF Portfolio Builder, the second question is how much you want to invest. This is not going to influence the performance of your portfolio, but it's going to be useful because based on that, the tool is going to tell you here how much money you have to invest in every single ETF. So for instance, with $1,000 and the current configuration, it says $500 in VO, $300 in QQQ, and $200 in VAG. We're going to see later that this is going to be really important because with more complex portfolios, calculating the money to invest in each ETF gets more complicated. Question number 3 is if you want to give up bonds. This is simply for people that are older than 45 years old, but still don't want to have bonds in their portfolio. So for example, if you're 50, the tool is going to say here 40% on bonds. But if you choose here, yes, I want to give up bonds, the tool automatically sets bonds to 0%. Question number 4 is if you want international coverage, namely markets outside the US. There are continuous discussions about the need of international stocks in a portfolio or if an investor should just focus on the American stock market. Those in favor of an all US portfolio say either that the US always performs better than other markets or that the biggest companies of the US economy are indeed international companies because they sell worldwide. Those instead in favor of international investments believe that the US will not be the best performer forever and therefore international diversification is going to protect you from crashes of the American stock market. Me personally, I'm bullish on the American stock market, above all now that the US has demonstrated to be the only country that invested heavily in AI, but there is something that I want you to know. The US and the international markets have moved in cycles. The US has been overperforming for over 13 years now, but it wasn't always like this. The international markets outperformed between 1975 and 1980, between 85 and 90, as well as during the last decade between 2002 and 2010. Now, considering that the average outperformance cycle lasts about 8 years, and right now the US is overperforming since 13, an overtaking of the international market is possible. So feel free here to select yes if you want international coverage, and the tool is going to consider VXUS, the Vanguard Total International Stock Index Fund ETF. VXUS returned 13% in the last 12 months, 30% in the last 5 years, and 60% in the last 10. As you can see, a big difference compared to the American stock market with VO. Then, if you don't want VXUS, an alternative is IXUS or something like VEU. Next question is your investing experience. You can choose here 0 to 1 year, 1 to 2 years, 2 to 5 years, or more than 5 years. The more experience you have, the more complex the suggested portfolio is going to be. Let me start though by saying that just because you're more expert doesn't mean that the portfolio has to be more complicated. In fact, the simpler the better. But the opposite, that's what I want to avoid. That you are a beginner and you build a complicated portfolio. That is for sure something you must avoid. So, if you choose 0 to 1 year, as a beginner, the tool leaves away all the ETFs that are specific to sectors or smaller portions of the market. In this case, it tells me to invest 80% in the foundational ETF VOO and 20% in VXUS to have international coverage. If I decide that I don't want international coverage and I choose no here, it's going to suggest 100% in VOO. A simple portfolio, just one ETF, but in the last 10 years would have given you a total return of 246%. Not bad. But now, for the sake of the video, let's also include the international ETF. Let's say that you are not a complete beginner, but you've been investing for 1 or 2 years. In this case, the tool also includes a growth ETF like QQQ and a value ETF like VAG. I'm going to explain later why these ETFs, so now just notice that the more experience you write here, the more complex the portfolio is going to become. If I choose over 5 years, for instance, the portfolio is going to include also VO, the Vanguard Mid Cap Index Fund ETF, and VB, the Vanguard Small Cap Index Fund ETF. For those of you who don't know the difference, large, mid, and small cap stand for the capitalization of the companies inside the ETF. So basically, the value in dollars of the companies. Companies with a value over 10 billions are usually considered large. Between 2 and 10 billion, they are considered middle, and under that, small companies. What's important to know is that the smaller the companies inside the ETF, the higher the volatility. Namely, the price is going to fluctuate more. What's interesting is that if you look back at the whole performance since 1994 to today, small and mid-cap companies have returned more than large cap. Mid-cap returned 11.7%, small cap 10.78%, and large cap only 9.67%. Obviously, past performance is not a guarantee of future results. And in fact, large cap companies might perform better from now on, just like they did in the last 10 years. Next and last question is if you're growth or dividend oriented. I could have written here growth or value oriented because value companies usually tend to pay out more dividends, but investors in the value sector usually do it mostly for the dividends, so it's easier like this. Now, there is nothing wrong with any choice here. The only thing to consider is that growth has been performing better in the last 10-15 years. And if we believe that the technology sector is going to be the best performing sector in the future, because technology is becoming part of everything we do, then we might assume that in the future, growth will keep performing better. For the growth ETF of this portfolio, I've chosen QQQ. QQQ is the most purchased growth ETF in the world and tracks the top 100 market cap weighted non-financial companies which make up the Nasdaq 100 index. QQQ returned 31% in the last 12 months, 156% in the last 5 years, and 424% in the last 10. A cheaper version of QQQ is QQQM, which is identical. Or you can choose VUG, the Vanguard Growth ETF, SHG, the Schwab US Large Cap Growth ETF, or even a tech ETF like VGT or FTEC. For the value ETF of this portfolio, or better said, the dividend ETF, I've chosen VAG, the Vanguard Dividend Appreciation Index Fund ETF. VAG returned 27% in the last 12 months, 83% in the last 5 years, and 207% in the last 10. Alternatively, you can go for VYM, SHD, or even FTVV. So what happens if you choose that you are growth or dividend oriented? Simply put, the tool is going to give more weight to growth or to value. For example, in this case, I have 21.6% in QQQ and 16.2% in VAG, while if I choose dividends, I get the opposite weights. Now, the interesting question is, would I beat the market or not with my portfolio? For this, I've built an interesting function in this tool that compares the performance of the last 10 years of the total stock market with the performance of the portfolio that you set up answering the questions. So for example, in the current configuration, our complex portfolio that you see here would have returned a total of 246.29% in the last 10 years, which is equal to 13.23% per year. This is, as a mere coincidence, exactly the same as the 246.3% return that you'd have achieved if you simply invested in VO, which represents the markets. The reason we didn't manage to overperform is that many portions of this portfolio actually performed worse than the S&P 500 in the last 10 years, namely the International Market ETF, the Mid Cap ETF, and the Small Cap ETF. So by choosing here a lower experience, let's say 2 to 5 years, and by giving up international coverage, we get a portfolio that in the last 10 years performed much better than the S&P 500, with an average of 14.76% per year in the last 10 years. To make it short, even though nobody can really know how to create a portfolio that for sure outperforms the market, because the future is yet to come, we can surely say that the growth sector, and in particular the technology sector, not only have been the best performers in the last 15 years, but are also the most promising for the future. So a portfolio tilted toward growth is more likely to outperform in the future than a portfolio tilted toward value. Obviously, don't forget what I always say in my videos, namely that the technology sector is highly overpriced right now, so a correction or even a crash can always happen. The last thing I want to show to you is a rebalance tool that I created here. Let's say that you set up your portfolio with the percentages that I wrote here. And after 1 year, some ETFs grew more and some less. What happens is that you're going to have a portfolio that is not balanced anymore with the original percentages. So this rebalance tool tells you exactly what and how much to sell and to buy in order to get back to the original weights. To give you an example, now the right percentages according to our portfolio are written here and are taken from the table up here. But let's say that now we have $8,000 in VO, $1,000 in VXUS, $4,000 in QQQ, $5,000 in VAG, $500 in BNB, VO, and VP respectively. The tool analyzes the percentage in your current portfolio and tells you for each ETF how much you need to sell or to buy in order to get back to the right percentages. Cool, right? So if you enjoyed this video, please be nice and support me with a like. And of course, don't forget to subscribe to this channel for future videos like this. If you want to learn how to build a portfolio from a different perspective than the one that I addressed in this video, I suggest you watch my video called How to Build a Lazy Portfolio into a Money Machine. I'm gonna link it here so you can just click on it and you'll end of the video. I wish you a great day, everyone. And as always, I'll see you in the next video. Ciao.